Public CEO Report is a podcast that provides insights about the public sector and public policy for the benefit of decision makers and leaders powering our communities. I'm your host, Ryder Todd Smith, and today we're joined by Jose, Vera, and Parker Colvin, Managing Directors at Raymond James. Jose and Parker, welcome to the Public CEO Report.
Thank you.
Good morning.
So let's talk, gentlemen. Tell me about what you guys do in local government. Why don't we start with you, Jose?
Well, we help local communities finance their public infrastructure through the issuance of municipal bonds. And so Raymond James is a top 10 national underwriter of municipal bonds, and we access the capital markets for our clients.
All right. So I think a lot of people have heard of muni bonds before. I think that makes sense. And what are your respective roles? Parker, what's your role relative to Jose?
Sure. Well, I'll let Jose describe his in more detail, but my specialization is being kind of the point person between capital markets and our public agency clients. So I'm not out identifying projects or working hand in hand with the public agencies like Jose is. My job is to come in kind of at the last minute and execute financings, help people access the capital markets at the lowest possible cost of financing.
So you're closer to the money in Wall Street, and Jose is closer to the municipalities that are looking to actually do projects. Is that a fair description?
Exactly right. Yeah.
All right. Well, it sounds like we need the duo of you to make things happen, right? So to get the money efficiently from the markets and find great projects to finance.
You know, my smile could only do so much if I don't have someone like Parker behind me making sure that the rate is low.
That makes sense. Yeah. How many basis points is your smile worth, Jose? So how did you both get into the local government finance sector? Parker, we'll start with you on that.
I fell into it, in college. I didn't even know what a municipal bond was. I was math and computer science track. I was a summer intern for a little company called Stone & Youngberg in San Francisco and designed a website for them. And from there, I found my way onto the trading desk and found out that trading bonds was something I really enjoyed, and took off on that path for probably the first 4 years of my career, only trading the secondary market, and then started to cross over a little bit from the secondary to the primary market, or new issue pricings, where you interact with public agencies, and found that was the most enjoyable part of the work for me. So a little over 20 years in now as a trader and underwriter, and for the last 10 years or so, I've been pretty much exclusively focused on the primary market. Okay.
And then how about you, Jose?
So after graduating from MIT, I didn't have a job. And my buddy Harsha, who's the most successful person I knew at the time, took me out for a beer and told me about public finance. And he did it in such a way that not only did the bartender that was eavesdropping picked up the bill, but he's probably become a public finance banker too. So he sold me on it. I sent my resume out to every single firm in California that did public finance and had a website, and Stone & Youngberg called me back. And so that's how that happened.
So you two actually did you end up working together at Stone & Youngberg previously? Do you have a history together back then?
Yeah. So Parker joined Stone & Youngberg like the next month after I was hired. So we've known each other for quite a bit.
And so your careers have interwoven through those days. And now you're back together again under Raymond James.
Correct.
Exactly.
Yeah, small world. So what is working well in local government finance?
I'll say that right now, just there is a lot of liquidity in the sector. So there's a lot of money looking for fewer bonds, and that drives rates down and gives the local agency an opportunity to refinance debt, get access to capital at low rates, and address infrastructure issues. So that's working really, really well. If there's ever a time when there's a disruption in the market, that's when you see things not working quite as well. But part of our job is to have our capital ready to deploy in situations that there's volatility to ease those volatile times.
And Parker, why is there so much money chasing the municipal market or trying to fund muni bonds?
Yeah, I mean, I think it goes right to the Federal Reserve, and the bringing the overnight rate to zero in response to the onset of the pandemic, hitting the market with massive quantitative easing, and even though they're not directly buying municipal bonds, buying every other asset class in massive size to keep low rates down, just spreads the liquidity and pushes the investors into other markets. So I would say, kind of in the frothy market of 2006 was the only time when liquidity was as close to as strong as it is right now, and rates are a heck of a lot lower now than they were then. So, when I'm bringing a transaction to market on behalf of a public agency, we kind of go over the options that are available in the market, what different types of buyers are looking for, where the pockets of strength are, where the segments of weakness to stay away from. Right now, it's pretty much all strength, and all options are on the table. We, not to get too into the weeds, but couponing and call features and all the different ways that we package bonds to fit in investor portfolios in a way that meets the needs of public agencies. I would say no time in the last 20 years have there been so many options readily available. So really, if there's any financing need out there, we can structure something to fit in this market because there's just so much liquidity, as Jose said.
So, basically what I'm hearing is there's never been a better time to do a bond deal than right now for a government agency or local government agency, assuming they have a project that they warrant it, of course. So usually, things are going great until they're not. So what should public agencies be concerned about?
Well, I think you hit it in the head. Things are going well until they're not. And I remember how if there's a difference in opinion, you have a market. In muni bonds, when there's a difference in opinion, you kind of halt trading. So usually the spikes of the raise in rates happen pretty suddenly. So I think while the going is good, it's a good time to refinance bonds, address capital infrastructure while inflation. Before inflation makes the cost of those improvements prohibitively expensive. And when the music stops playing, we'll deal with that then. But you got to think that there's got to be a correction at some point.
Right. Parker, any comments on that?
On the bond pricing side of things, there aren't too many landmines out there. Maybe it's a good time to be selling fixed rate debt instead of variable. But on the financing team side, when you're putting something together, as long as you're using conservative assumptions right now, the interest rates are so low, they're going to help projects get done more easily than they would otherwise. So, maybe if you're getting really aggressive rates, it's a good time to be a little bit more conservative on your other assumptions.
So I guess at the risk of getting super technical here, Parker, you had made some comments that a lot of the bond rates were being driven by Fed activity. I wanted to say my last read on a Wall Street Journal article was that Fed Chair Powell was looking to start pulling back on some of the purchasing they're doing in the month of October and start easing up a bit on their efforts. Maybe I misread that. Is there any Fed policy coming down that has been projected by the Fed that should kind of at least raise a yellow flag for people, or they should be aware of some change in the climate?
I think we're just. I think the Fed is signaling that they're just beginning the conversation about when the appropriate time to wind down quantitative easing might be, and that's just stopping purchasing of bonds. That's not flooding the market with what's on the Fed's balance sheet. Really, the only thing that might motivate the Fed to move faster rather than slower would be sustained inflation. Today's consumer price index reading was a little bit lower than expected, kind of proving the point that the Fed's been making for the last 6 months. When you're comparing year over year to 2020, we don't need to panic about higher inflation numbers because, obviously 2020 was a dramatically weaker year for prices. So today's CPI number is a tiny bit lower than expected, and the bond market rallied. So the headlines in financial press today are that the taper is off the table for now. That could change in a week, but that's how the financial headlines are reading today.
And I should note that by today, we are recording this on September 14th. So if you're watching this on September 26th or October 15th, it's been a month and the data is old at this point. But in the context of this conversation, that's kind of what we're contending with.
Good point.
Yeah. Jose, any other comments around that point or that issue?
No, I mean, going back to the question about what should local agencies be concerned with, I know that unfunded liabilities has been a topic recently that many agencies are addressing in terms of pensions, but I think unfunded liabilities come in many forms and many flavors. And I think deferred maintenance and unfunded capital improvement programs is something that many cities have deferred for many years. And the public infrastructure is the backbone of many communities, and we all kind of depend on it. And so making sure that it's working and is up to date is a quite essential role of local government. And so that's something that is easy to kick the can down the road, but it's the rubber does meet the road at some point, especially when there's natural disasters and a host of all other things threatening our infrastructure.
Yeah. You had also both had made some comments about kind of historically low rates. Could you just put some context on that? I mean, what roughly speaking, and I realize there's a million variables, but how would you, when you make that statement, what are you comparing? Where are those rates? Where in the last 30 years, what has been the high relative to the lows that we're kind of bottoming on right now? So
it's interesting that the Municipal Market Data Index has been tracked since 1993. And I joined the business in around 1999. At the time, in the early 90s, rates could have been or were around 7%, 6%. Today, in the last 12 months, that same 30-year Municipal Market Index has been below 2% and currently sits in the mid 1.5s. And Parker, tell me if I'm wrong on that, but the last 12-month period, it's at the lowest level it's ever been.
Yeah, that's right. I think there's two components to actual borrowing rates out there. There's the index, which represents the highest credit quality, most liquid bonds in the market. So those are the benchmark and obviously the lowest yield. So the benchmark hit the lowest levels in its history, going back to 93 in August of last year, kind of the peak fear of the economic fallout of the pandemic. But amidst that fear, so the reason rates are so low, people are buying high quality assets at the expense of riskier assets. So for your typical public agency, they don't borrow at the national AAA rate. They're going to borrow at some credit spread to that. So what's happened is we've gotten through the first 9 months of 2021, it's become apparent that the economy is not going to be back to pre-pandemic output immediately. Inflation looks manageable, so the index was able to creep back down again. It's not at the lowest that it was, but it's within a quarter point. But credit spreads have dramatically compressed because there's less concern about problems in municipal credit. Municipalities have fared the pandemic very well, so the actual borrowing cost for agencies is lower right now than it was a year ago. Even though the benchmark index might not be quite at its all-time low. And that's both for taxable municipal bonds spread over treasuries and tax exempt, where we use the AAA MMD index.
So Parker, that actually, given that these historically low rates we're talking about here, I guess I have one other factor that just looms in my head. Municipal bonds, to the best of my understanding, for most investors, they actually represent tax-free income, or they are not subject to income tax. And I realize you're not a tax attorney, so maybe you can't offer this explanation, but is that generally the case, or how does the market work on that? Or maybe, Jose, you need to answer that question.
No, that's generally the case. Most municipal bonds are exempt from federal income taxes, and a significant majority are exempt from state income taxes as well. There are certain exceptions for that. And then there are certain uses of proceeds that do not fall under that tax exempt status. And so for those purposes, you'll see bonds that are subject to alternative minimum tax or are federally and state taxable. But traditionally, the plain vanilla municipal bond is exempt from state and federal income taxes.
And I think your confusion, Ryder, may come from the fact that we have seen over the last few years tremendous resurgence of taxable municipal bond issues. So advance refundings were pretty much prohibited on a tax-exempt basis since 2017, I believe. And so there's been quite a few advance refundings done as a taxable financing, thanks to the fact that Treasury rates have been so low. So you could structure a tax-exempt a taxable municipal bonds spread off of Treasuries and still get a very attractive low rate. Additionally, pension obligation bonds have been done or can only be done as taxable bonds. And so there's been quite a lot of bond issues for pensions done as a taxable financing.
Okay. So I'd always had this perception that the no tax municipal bond was particularly attractive to high net worth and high income individuals who were looking for income streams that were not going to be subject to their high marginal tax rates. Partly, I just think about that because given recent federal government policy changes, there's been more movement and shift towards or a potential shift towards increased tax rates for high net worth individuals and high income individuals, which I would assume would make municipal bonds even more attractive, at least for that cohort of purchasers in the market.
Absolutely. Even though not all retail buyers access the market themselves, via a broker buying individual municipal bonds, the aggregate individual investor demand is the strongest source of demand in our market. There are a lot of buyers that we refer to as professional retail, where you've got a money management firm or a bank trust department buying large chunks of bonds and splitting them up into individual accounts. Those folks represent particularly in California, represent probably the strongest buying base in the first 15 years of the yield curve. And then you look at the mutual funds who are buying, those shareholders are also largely individual retail investors. So while there certainly are banks and hedge funds and insurance companies and true institutional buyers, the municipal market is very dependent on retail demand.
Okay. Thank you for kind of indulging my query into that space. I'm always just curious about because theoretically that's where some of this capital is coming from that's flooding the market too, is some of those buyers, right?
Absolutely.
So that maybe broadens out the question. Raymond James is a big organization, right? What all does Raymond James do? Because I assume public finance is not the only thing. I've heard of the name for many years.
You want to go first, Jose? Or,
yeah,
I'll mention just one thing.
Go ahead.
I think Raymond James, primarily we're a household name as an individual financial advisory firm, close to 20,000 employees. Most of our associates are involved in advising individual investors on their investments. And, capital markets, fixed income and equity capital markets are just a couple of smaller departments in addition to private client group. So go ahead, Jose.
Yeah, so in terms of size, not only the 20,000 employees, but at last count, we had approximately 1.2 trillion of client assets under management. So you could think about the whole host of products that we offer all those clients and in order to manage those assets. We also happen to have our name on a football stadium in Florida. So it is a household name, and I think both Parker and I are happy to be part of a much larger organization.
How does that size benefit public agencies?
So I think part of what we do is not only underwrite bonds or sell bonds, but also underwrite bonds. And so you have to have the capital to be able to take some of these bonds in when needed. When you set a price and you believe that price is fair, but there's enough volatility in the markets that if you don't stand by that price, you would need to adjust higher or lower. it's good to have the level of capital that allows you to be firm with your convictions. And I think that's what Parker does best. So if you have little capital, you kind of have to yield to what the market is telling you, because you can't take those bonds in. But when we have the kind of organization we do, and the flexibility that Parker has as an underwriter to call those shots, it really is to the benefit of the public agency.
It sounds like you essentially are in a better position to assure some sort of pricing certainty with them once you agree on the pricing for the deal.
That's correct.
Yeah. Okay. Well, I mean, certainty is probably that's why people are in the bond market in general, is they're looking for a lot more certainty or conviction than they would get in other spaces. So that would seem to go hand in hand. Anything else? How is Raymond James involved in other financial activities with municipalities beyond bond deals and underwriting?
Yeah, so we have a group that manages or help invest treasury assets for cities, counties, and local governments. So we're on the investment side of things as well. We do also escrow bidding services for when monies from bond issues needs to be reinvested. We have a group that does that as well. We have a housing group that is very relevant into what's happening here in California, and as well as we're a big syndicator of low-income tax credit to bring equity into low-income housing financing. So we do quite a bit of roles throughout our issuer clients, and so we host a whole suite of services for them. Okay. Anything you want to add on that, Parker?
I think Jose covered it. I interact a lot with our local agency investment side as well, because a lot of municipalities in California buy the bonds that are issued by other municipalities. So I can say that that's something very unique amongst our competitors. When we're involved in multi-firm syndicates, we generally have a lot more interest from California municipalities than other firms do. So a lot of municipalities actually know us more from the investment side than from the investment banking side. But if they don't, I think that's those services are pretty unique and special. They should definitely look into those.
Right. So partly, I guess what the point I'm hearing, maybe not the point, but an observation is, it sounds to me like a good chunk of the municipalities in California actually own debt in other municipalities in California. Is that an accurate statement?
Yep, that's right.
All right. Well, it's good to know that they're investing in their peers. I suppose that's perhaps a good sign. So as many agencies are addressing debt or losses in revenue because of the pandemic, what are some strategies you might suggest for public agencies to pursue financial responsibility?
So I think I mentioned earlier about addressing the unfunded pension liabilities. I think that's something that many cities and counties and local agencies are doing. I think setting good policies and sticking to them is something that I think many agencies are starting to do.
What does that mean? Like what's it like?
Yeah,
policy on a fund reserve, or is that a policy on trying to curtail growth and expenses?
Yeah, well, you can't always cut your way into prosperity. So, but identifying things like a Section 115 trust to address the pension problem, and identifying one-time revenues, and rather than using it for ongoing multi-year expenses, put it into a trust as a form of a reserve. Those are just sound policies that if you implement them and stick to them, you'll be better off down the line.
Fair point.
Now, simpler things that are lower hanging fruit, and we talked extensively about low interest rate environment. But yeah, take a look at your debt. There's likely a very good chance that bonds that you did 6, 7, 8 years ago are now callable, and you could lower the payments on that. So being proactive in how you manage the debt side of things will save you money.
Yeah, I keep. I mean, I certainly have seen various reports of agencies crowing about their refinancing they're doing and the amount of money they're saving on interest expense as a result of essentially issuing new debt to replace the existing debt, as I understand it, and using that interest rate savings to put themselves in a better financial position. And that over the duration of that bond deal, they'll end up saving, X millions of dollars as a result of doing the refinance.
Yeah, it's no different than taking advantage of a low mortgage rate after you've had your mortgage for a while. You take a look and say, oh boy, I saved quite a bit of money here.
Yeah. So another thing I've been hearing a lot about in the space and aligned with government in particular is this idea of green bond projects or green financing. I think in the context of wildfires in California and climate change concerns, if not outright alarm, there's a lot of interest in this area. Could you explain a little bit about what that is and how public agencies should consider some of these investments?
So Raymond James happens to be a market leader in green bonds. And so let's take a look at it from a utility, let's say water, sewer, or power infrastructure. Many of those projects, if you look at it, how they are done, would qualify for green bond status. Environmentally friendly construction for city halls and police stations, or environmentally friendly park infrastructure would qualify for green bond status. Things like energy retrofit, when you're changing street lights and HVAC systems in your existing buildings, that sort of stuff could qualify for green bond status. So having the discussion with your financing team and your legal team and making the disclosure required by the investor community would help you get that ESG, environmental, social, and governance designation. It is a growing field, so you're starting to see more and more funds targeting green or ESG investment. It's something that eventually will provide a real savings to the client. Right now, I think because, and Parker, please speak up on this, because it's relatively new, it's harder to quantify whether a green bond designation is saving you 5 basis points or not.
Yeah, no, it's a sector of the market that's taken a lot more specific shape over the last 5 or 6 years, but it's still not one single clear definition of what is a green bond. So the demand is being driven by investors. However, there are a lot of investors out there that are looking for ways to invest in environmentally sustainable projects, social impact investing. Those avenues have been pretty big growth strategies for professional investment advisors. If they offer a product that seeks to invest in those types of bonds, the response from individuals has been really strong. So the professional investment firms out there are all at some stage either early or advanced in offering those products to individuals, and then we see those funds get put into our market. At the moment, for the same issuer, same credit, one green bond, one not, they are still pricing the same. But I would say we've had some smaller issuers come to market who have had investors participate in their transaction who wouldn't have ever looked at a $18 million utility deal if it wasn't a green bond. So there's a greater depth of audience for green bonds than not. And I think as that the investment strategies continue to grow and formulate around that, it's going to have a bigger impact on pricing in our market.
So in some a little bit of layman's terms on this, but my sense is twofold. Number one, the supply demand situation. If there's only a certain supply of green bonds and there's a bunch of demand out there that wants to invest in green bonds for meeting various investment goal requirements or philosophies of the funds that are making the investments, they'll be chasing down those deals and willing to invest. And anytime you have demand exceeding supply, meaning more demand for those deals than there is supply of actual green bonds, then theoretically the interest rate should come down, and therefore the green project itself gets better financing terms. I mean, that's the fundamental theory behind this.
That's exactly right.
Yeah. Okay. And so right now we're not seeing a lot of pricing benefit for the green bond space, but the space is starting to gel up more, and there will be some higher expectation that'll really start to manifest. I would also have to imagine that one of the other challenges is interest rates are just so low in general right now that creating separation between one bond type and another is pretty difficult in an interest rate environment that's so darn low. Is that I mean, again, that's a layman's observation, but is that an accurate description?
No, that's an insightful comment. I mean, in a more challenging market, as I mentioned earlier, this is sort of a time when anything an issuer wants to do, we can find a buyer for it. There are definitely market environments where no, we need to fit in some square holes here in order to find investors, and there might be sectors of the market where there's no one. I think when we get to a market where there's less liquidity like that, where some sector of institutions are selling versus every single sector of institutions buying, yes, then that'll be a differentiator where you can find a buyer for a green bond, or where there might not be demand for a generic purpose.
Well, it'll also just be interesting to see how much of a how many basis points or how much investment return investors are willing to give up for the sake of a green product, right? In an eco-friendly solution, or meeting one of their ESG goals, excuse me. So that'll be a fascinating evolution in the capital market space. So let's zoom out to 32,000 foot perspective just real quick. Maybe Jose, can you just summarize for us some kind of deals that have been done by Raymond James lately, or some projects you've worked on that helped address public agencies' financial concerns?
Yeah, so especially during the pandemic, I think we had some clients that wanted to hold on to their cash. And while they had infrastructure programs that they wanted to fund and had earmarked with that cash, they chose to access the capital markets, borrow for the infrastructure, and keep their cash and reserves, just to see if things got worse, that they'll be in a good position to withstand the downturn. We've seen some other agencies that were impacted by the fires that had a big portion of their tax base decimated, and had a big impact on their budget. They were expecting federal funds to come in, but needed to access the market with short-term notes while that money came in. We've seen agencies that simply are looking for every last dime and wanted to refinance their debt, as you mentioned earlier, to make sure that the excess revenues could be used towards economic development and try to find a way out of the slowdown. And lastly, I've mentioned it before, but pensions. I think people are looking at the impact of a lower discount rate by CalPERS, which is putting pressure on budgets, and restructuring that payment.
Yeah, fair enough. That makes sense. You got any additional comments you want to make on that?
I would say that an additional thing that I've been working on lately, and maybe it's a trend, but I think people are starting to wake up to the street infrastructure. I think a lot of streets are run down and need to be improved. And so we've seen this year a couple of clients that are saying, you know what, we're going to go ahead and invest in our streets and fix them.
Yeah. One thing I've always reflected on is this kind of yin and yang of when these investments happen, because the old ethos, particularly under certain Keynesian theories of economics, was that when the economy was in the tank, you'd start making major capital investments because things were always cheaper to get done. Right now, it's a little bit of a challenging environment because things aren't necessarily cheaper right now, and the tank was artificially, or the economy was artificially tanked as a result of the pandemic, and seemingly bouncing back with aplomb. So the interesting thing is, it's instead of right now it being a super cost-effective time to make some of those infrastructure investments, some of the reality is I think agencies are looking out of the horizon and going, if we wait another year, it's another 5% increase, and that's going to far exceed the interest cost on doing a debt deal now. So we ought to just get on with it. Like, the sooner we can get stuff done, the sooner we're going to mitigate these seemingly, I mean, we'll see what happens with inflation, but seemingly relatively steep inflation curve that we're facing.
You have a good point. I think when they're looking at a 30-year borrowing rate that is, for most agencies, well under 3%, it's seems like a good alternative to tackle some of the infrastructure problems.
Yeah. All right. Well, so Parker and Jose, do you guys have anything else going on in the financial markets you want to talk about, or any other trend items that we haven't raised today in this conversation that you think public agencies should be aware about?
Trend-wise at the moment, we're at a real quiet point in the municipal market. Secondary volumes are really light. Rates are just kind of stuck at these super low levels. And if we look at what's going on in other sectors, the corporate market has seen just a tremendous flood of issuers coming to market. $75 billion in corporate bonds was issued last week. The 30-year Treasury market had one of its best auctions ever last week. So, municipals tend to lag a little bit, some of those faster moving sectors. But, as you mentioned, when is the right time to take on a project? Maybe construction bids are down when the economy's slow, but that might run counter to interest rates as well. So I think we've been saying rates have been low for a long time. So maybe it's getting to be a bit of an old message. But when we see the types of transactions that are getting done, affordable housing projects, anything real estate related, even transportation sector coming back to the market after the pandemic, it just seems like it's a good time right now to think about a market that's got a ton of pent up demand. Maybe if it's just refunding bonds, when things are kind of quiet like this, it really tends to advantage the first movers. When everybody kind of gets the same idea, our market can't absorb the same kind of supply as the treasury market. So, at some point, supply is going to come in and it's going to overwhelm demand. But for the folks that are in ahead of that, I think it's going to provide some real advantage.
Okay. All right. Very good. Well, and how, let's say our friends out there listening want to actually tap some of the expertise or talk with you all. How, Jose, let's start with you. How do they get a hold of you?
Well, an email is very, very easy way. So jose.vera@raymondjames.com. And my phone number is another easy way. So I'll tell you, it's 818-489-6836.
Awesome. And Parker, do you ever get to talk to clients too, or do they try to keep you behind a curtain and only let Jose talk to the clients?
Jose is very well trained in client management. I tend to put my foot in my mouth. So
we won't
email me at jose.vera@raymondjames.com.
Well, that makes sense. It's a wise man who can recognize when it's better to let somebody else do the talking. I appreciate that. All right. Well, thank you both. That's today's report. My name is Ryder Todd Smith, and we've been joined today by Jose and Parker. So my thanks for you both joining us. Thanks for your time, and have a good day.
Thank you very much.
Thank you.
We hope you learned something new and inspiring that'll help you in your public service. Remember, PublicCEO has a daily newsletter that is free to those who sign up at PublicCEO.com. If you have feedback, questions, or guest suggestions for PublicCEO Report, please email alex@PublicCEO.com.